Welcome back to Talk Tickers. Today we are looking at a situation that, quite frankly, looks like a glitch in the matrix. We are analyzing a company that just reported its fourth quarter earnings.
Right.
They missed on revenue, they missed on earnings per share, their profit margins got squeezed, and yet in the after-hours session, the stock price, it didn't tank.
Yeah.
It didn't even wobble. It ripped 8% higher to over $212.
It's one of those classic moments that separates, the algorithm readers from the actual analysts. If you just read the headlines, you're selling. If you listen to the call, you're buying.
Exactly. We're talking about Texas Instruments, ticker symbol TXN. This is the company everyone usually thinks of as the steady, boring grandfather of the semiconductor industry. But after digging through this Q4 2025 earnings call, boring feels like the wrong word. We have a lot to unpack here. A potential cyclical bottom, a massive change in capital spending, and a surprise entry into the AI race that nobody really saw coming.
It really just comes down to the difference between looking backward and looking forward. The backward-looking numbers, they were messy. There's no sugarcoating that.
None.
But the forward-looking guidance signals a massive inflection point.
Let's start with the mess, just to set the baseline for everyone. We need to understand what the market is forgiving here.
Sure. So top-line revenue for Q4 came in at $4.42 billion. That was a miss. Consensus was looking for about $17 million more.
Okay.
It is up 10% year over year, which sounds okay. But sequentially, compared to the previous quarter, it was down 7%.
And the bottom line wasn't much better on the surface.
Right. GAAP earnings per share hit $1.27. The street wanted $1.29, so a 2-cent miss.
A miss is a miss.
It is. But to be fair to management, they did point out a surprise 6-cent reduction from some non-cash impairment charges and tax items. So if you strip out the accounting noise, operationally, they actually did a little better than expected. But the headline number that flashes on the screen, that was a miss.
And gross margins dropped to 56%.
Yep, down 150 basis points sequentially. So profitability is compressing.
Okay, so we have a revenue miss, an earnings miss, and compressing margins. By all rights, this stock should be in the penalty box. Why is it at $212?
The guidance. This is the entire story. Management provided their outlook for the first quarter of 2026, and it just blew the estimates out of the water.
Yeah.
They guided revenue between $4.32 and $4.68 billion.
Which is good.
It's fantastic contextually. The midpoint is way above what Wall Street had modeled. But the real signal here isn't just the raw number, it's the seasonality.
Break that down. Why does the seasonality matter so much here?
Because the first quarter of the calendar year is almost always the worst time for chip companies. The holiday shopping rush is over.
Right.
Factories in Asia shut down for the Lunar New Year. Demand usually just falls off a cliff.
Yeah.
But Texas Instruments is guiding for revenue to be effectively flat or even up sequentially from Q4.
That is extremely rare for them, isn't it?
It's almost unheard of in a down cycle. In fact, during the Q&A, an analyst named Ross Seymour pointed this out. He noted that TI hasn't guided up sequentially in a Q1 since 2010.
2010. That is right after the Great Financial Crisis.
Exactly. That's the comparison we were dealing with. 2010 was the beginning of a massive economic expansion, a huge cyclical recovery.
Wow.
If Texas Instruments is seeing demand patterns today that mirror the post-2009 recovery, that implies the industrial recession we've been hearing about for 2 years is officially over.
That is a massive signal.
Yeah.
Did the CEO confirm that? Or was he trying to walk it back?
Haviv Elin, the CEO, he didn't shy away from it at all. He credited a broad recovery in the industrial sector. He basically said that even though industrial is still about 25% below its peak from 2022, the recovery is happening across the board.
Okay.
And he used a specific phrase that I think we need to define because it's critical. Turns business.
Turns business. I saw that in the transcript. It sounds like supply chain jargon. What does it actually mean?
Think of it like a restaurant. Usually, big industrial clients make reservations. They order chips 6 months in advance. That's the backlog.
Got it.
Turns business is walking traffic. It's customers showing up today saying, I need chips right now, please ship them tomorrow.
Which implies they're desperate.
It implies their shelves are empty. It means they've burned off all their excess inventory and are now buying to meet real, immediate production needs.
So the glut is gone.
The glut is gone. And crucially, Haviv noted this revenue growth isn't coming from raising prices. Pricing is expected to be down low single digits. This is pure volume. People are buying more physical units.
So theme one is the cyclical turn. The economy is waking up. But let's move to theme 2, because this feels like the strategic shift that changes how we value the company. For years, TI just lumped their sales into these generic buckets.
Right.
But on this call, they made a specific change to their reporting structure.
They did. For the very first time, they officially broke out data center as a standalone end market.
Which is basically them waving a giant flag saying, hey, we are an AI stock too.
It is exactly that. And the numbers back up the swagger. They revealed that data center revenue grew 70% year over year in Q4.
70%.
Yeah.
That is the kind of growth you expect from NVIDIA or a hot software startup, not from Texas Instruments.
Exactly. It now makes up about 9% of their total sales for 2025. We're talking about $1.5 billion a year in revenue just from data centers.
But I want to push back on this a little bit. We need to be precise.
Yeah.
Texas Instruments doesn't make the brains, right? They aren't selling the H100 GPUs. They aren't selling the high bandwidth memory.
No.
What exactly is TI selling into a data center that is growing at 70%?
They're selling the power plumbing. Think of them as the electrician of the AI revolution.
The electrician. Okay.
See, these new AI chips, the GPUs are incredibly inefficient in terms of power. They generate massive amounts of heat, and they require incredibly precise, stable electricity. You can't just plug a server rack into a wall outlet.
Right.
You need voltage regulators to step the power down. You need thermal sensors to make sure the GPU doesn't melt. You need E-fuses to protect the circuits from surges.
And these are all analog chips.
Mostly, yes. And this is TI's bread and butter. Haviv mentioned specifically that they're seeing growth in power and signal chain components. He talked about V-Core power modules.
V-Core. That sounds important.
It's the final stage of voltage regulation that sits right next to the processor. It has to react in nanoseconds to changes in the GPU's workload. As AI racks move to higher power densities, we're going from 40 kilowatts per rack to over 100 kilowatts. The number of these analog chips required per rack skyrockets.
So the thesis is essentially, the more powerful and hot the AI gets, the more boring chips you need to keep the whole thing from catching fire.
Precisely. It is a pick and shovel play. You don't have to bet on which AI model wins ChatGPT or Gemini or whatever. They all need power management. And by breaking this out, management is telling Wall Street, stop valuing us like a slow growth industrial company. Value us like a critical piece of AI infrastructure.
And with 70% growth, the market might actually listen. But we can't ignore the other buckets. You mentioned industrial is recovering. What about the rest? Auto, personal electronics.
Automotive was a mixed bag. It was up single digits year over year, which is decent, but it was down slightly sequentially. And management warned that Q1 is going to dip a bit.
Why the dip?
Seasonality, mostly. The Chinese New Year shuts down a lot of production in Asia, and China's a huge auto market. But Haviv emphasized that the secular growth story is intact. Even if car sales are flat, the number of chips per car keeps going up.
And personal electronics? I feel like that sector has been in a recession for 3 years.
It is still the weak spot. Revenue is down in the upper teens year over year. Phones performed a bit better than TVs and home appliances, but overall, it's still a drag.
Doesn't matter though.
Less and less, and that's a key point. Industrial, automotive, and now data center combined make up about 75% of TI's revenue. So whether or not consumers are buying new TVs matters less to the company's future than it used to.
Which brings us to the financial engineering part of the story. And this is where I think the bull case really solidifies. We have to talk about cash flow. For the last few years, Texas Instruments has been spending an absolute fortune on building new factories.
A staggering amount. They've been building these massive 300-millimeter fabs in Sherman, Texas, and Lehi, Utah. In 2025 alone, they spent $4.6 billion on CapEx.
That is a massive burn rate. Investors have been pretty grumpy about that.
They have. But this earnings call signaled the end of the pain. We call this the CapEx cliff. For 2026, the guidance is for CapEx to drop to between $2 billion and $3 billion.
So they're cutting the credit card bill almost in half.
Right. And this is simple math. Free cash flow is just the cash you generate from operations minus the cash you spend on equipment. If your revenue is going up because of the industrial recovery and the data center boom and your spending on factories is dropping by $2 billion,
Your free cash flow explodes.
it goes parabolic.
Yeah.
We are entering the harvest phase. They spent the money to build the factory shells. Now they just need to fill them with tools as demand comes in. It's a much cheaper phase of expansion.
There was one other number on the balance sheet that I want to challenge you on. Inventory. They are sitting on $4.8 billion of inventory. That's 222 days of supply.
It is a mountain of chips.
In almost any other industry retail fashion, if you had 200 days of inventory, you would be panicked. You'd be holding a fire sale.
Why is TI treating this like a trophy?
Because analog chips aren't like bananas. They don't rot. And they aren't like iPhones. They don't go obsolete in 6 months. A voltage regulator designed today will likely still be used in cars and industrial robots 10 years from now. So holding it doesn't carry a huge risk.
Very low risk of obsolescence. And strategically, it's a weapon. Remember the turns business we talked about?
Yeah, the walk-in customers.
If one of them calls and says, I need 10,000 parts by Friday, TI says, sure, they are in the warehouse. A competitor who ran their inventory too lean might say, wait 6 months for us to manufacture them.
So in a recovery, inventory equals market share.
Exactly. Haviv specifically said they are well positioned with this inventory to meet demand spikes. It allows them to be the reliable partner when everyone else is scrambling.
Let's zoom out to the investor context. We started by saying the stock popped 8%. But if we look back over the last year, TI has really been a dog compared to the rest of the sector.
A significant underperformer. Over the last 12 months, the semiconductor index, the SOXX, is up over 66%. Before this pop, Texas Instruments was up only about 9%.
So they basically missed the entire AI rally up to this point.
Because the market was obsessed with the direct plays, NVIDIA, AMD, Broadcom, TI was seen as the old economy chip stock tied to struggling industrial sectors. But this call suggests a rotation. As the AI infrastructure trade broadens out, investors are looking for value.
That's a catch-up trade.
Exactly. And there's a catalyst coming up very soon, February 24th.
What happens then?
They have a capital management call scheduled. Now that they've confirmed that CapEx is dropping, investors are going to be listening very closely to see what they plan to do with all that extra cash.
Let me guess. Buybacks.
Likely massive buybacks. TI has a long history of aggressive share repurchases. If they announce a plan to take that extra $2 billion of free cash flow and buy their own stock while it's still relatively cheap compared to the index, that adds a lot of fuel to the fire.
So we had the industrial bottom, the AI growth story, the free cash flow explosion, and a potential buyback catalyst. I can see why the stock is moving.
It's a very clean narrative setup for 2026.
All right, this brings us to our favorite segment. This is the part where we take all this analysis, throw caution to the wind, and pitch a trade idea. And please, listener, remember, this is not financial advice. We are just two voices in your headphones exploring the data.
Seriously, do your own diligence. This is for entertainment and educational purposes only.
Okay, hit me with it. If you wanted to play this sleeping giant narrative, how would you structure it?
I call this trade the boring AI moonshot.
I love a boring moonshot. What is the logic?
The logic is valuation arbitrage. Right now, TI is priced like a steel mill or a boring industrial company. But inside of it, there's a rapidly growing AI business growing at 70%. You want to capture the moment the algorithms re-rate the stock to a higher multiple.
So you think the market is going to wake up and realize, wait, these guys are a tech stock?
Exactly. So the trade is this. You go long EPS. Those are long-term equity anticipation securities. Basically call options that don't expire for a year or more. You want to target contracts expiring in late 2026 or early 2027.
Why that time frame? Why not just buy calls for next month?
You need to give the CapEx cliff time to actually happen. You want to be holding the position when those free cash flow numbers start hitting the headlines in the second half of 2026. You're betting on the slope of the recovery.
And you get the leverage of the options.
Right. If the stock outperforms the semiconductor index as it catches up, those options could print multiples of the stock's actual move. And there's a speculative wild card kicker here, the analog squeeze.
The analog squeeze. That sounds painful for someone.
It might be for the data centers. There's a contrarian theory that as everyone hoards GPUs, we'll eventually run into a shortage of the supporting chips, the power management stuff TI makes. If that shortage hits, TI gets pricing power back. If that happens, the stock doesn't just drift up, it goes vertical.
So the trade is betting on the plumbing of the AI revolution running out before the brains do.
It is the classic picks and shovels strategy, but with a leveraged twist. You're betting that the unsexy part of the stack is about to become the most critical bottleneck.
The boring AI moonshot. I like it. It's definitely contrarian.
It is certainly not what the crowd is chasing right now, which is usually where the opportunity is.
So, to wrap this up, Texas Instruments posted a messy Q4, But the market doesn't care because the future looks surprisingly bright. They are guiding for an industrial recovery reminiscent of 2010. They've revealed a hidden AI growth engine running at 70%. And they're about to turn off the cash-burning machine at the factories and turn on the cash-printing machine for shareholders.
The inventory correction, that phrase we have hated for 2 years, is essentially history. Now the question is just how fast the recovery ramps up.
And we will likely get the next clue on February 24th at that capital management meeting. Until then, keep your eyes on the plumbing, folks. That's where the power is flowing.
Keep watching the tickers.
We will see you on the next deep dive.